All right, the sky is falling. Everybody thinks the sky is falling on. Well, if you're trading NASDAQ futures, everybody thought today was some kind of definite showing that we're going to be going downhill. And I am going to be explaining in my own opinion, not financial advice for anybody, uh, as to why we're not going to be going downhill. This is just a technical analysis of what happened with NASDAQ today, as it did drop quite a bit. So first, what we're looking at is I'm going to go down. We're going to go from larger time frames down to the smaller time frames to try to get an understanding as to what happened. So, and if you know anything about technical analysis, if you know anything about smart money concepts, if you don't know anything about smart money concepts, hopefully this will help get you in the know, or at least get you aware of what was going on. So, first of all, we're taking a look at the weekly, right? So if we take a look at the weekly, we look at last week, we have a massive fair value gap as we ran up the entire week. Now, anybody knows anything about fair value gaps, generally what happens with these is that the price will want to come back down into the fair value gap. If it doesn't breach it just barely and then run up, then that's what we call an institutional order flow entry drill. We have not had that yet with this weekly order gap. Order gap. There's also things called order blocks, and that's what I mixed it up with. Sorry. Or what it'll want to come down is actually hit about halfway through, and that's what's called consequential encroachment. And generally, once you hit consequential encroachment, then it will also run up. But most likely, what you will get with these kind of things, especially when it leaves this large of a fair value gap, you will get either a consequential encroachment. You usually won't get an institutional order flow entry drill, but you'll also get a filling of the entire gap, meaning that this price could run all the way back down to this line here, 19,400, somewhere around that area. All right, so that is the weekly. All right, and I have a fib set, a Fibonacci sequence, if that's what if you don't know what a fib is, the Fibonacci sequence. I have a fib set at a certain way. All right, so if we go to the daily here, you can see that we had Monday, we had that huge run up. And when we had that huge run up, I already knew that we were going to be coming back down. I just didn't know when. I didn't know when that run down would take place. So we have Monday on the 17th, right? Then we had Tuesday the 18th, and then yesterday we were basically closed, so we had a half a day, but it's not showing on the daily. And then Thursday we had a news driver. What news driver was that? Well, let's go to the forexfactory.com and find out what news driver that was. I am recording this in the evening. It is just after close to show you what the news driver was, and it was unemployment claims. So we were expected to have about 235K forecast. Previously, we were at 243. And we came in a little higher than expected. So a little bit higher means more unemployment. So if we had had less unemployment, it may have been a little, to be honest, I think either way we probably would have had the same exact kind of determination as to what happened with those candles. Because I don't see it coming down here and then, oh, we had a good unemployment, so then we ran up. No, what happened is that we went 2x. Alright, so that's where my fib is. So if we go down here and put the fib, we put the last low before breaking a new high. So this was the previous high right here, which was Wednesday on June 12th. Right, then it comes back down to a low, and then we break that high. Once you break that high, that is where the bottom of your fib should be set. Now, where should the top of your fib be set? that is when I break it down to about the 4-hour, because there was about a consolidation point somewhere in there before it did break out right around this area, and I'm waiting for it to, there it is, and it's not showing my fib. Hold on, let me go to this one. I think this is the 4-hour. Here we go. Here's the 4-hour with the fib set. So you have the low right here at about 19,760, right? And then you have your high right here just before the breakout. This is where you put your 0%, which is about 20,013, 20,011. I think it's actually, we look at the actual price, it's 20,012 and 75 cents. Now again, this is the futures, the NQU, so this would be the September contract, not the May or the June contract. Okay, so then you can see on the 4-hour, it does have this huge run up on that Monday. To be honest, I lost money that day because I thought it was going to break down because we had multiple equal lows, and I thought it was going to be running down toward that to try to break those lows because there would be liquidity resting under that. Now, what does that mean? That means that there would be a lot of people that would have buy limits set just below this area, right? So they would have their buy limit set just below this area, and as soon as it hits those buy limits, they expect it to take off. Well, in smart money concepts, it goes against that. It would come down to those buy limits, run through them, and as you can see, there's another fair value gap over here. Now, it says it's been mitigated, but all that means is that it did come down into the fair value gap and then run up. So that will be called, again, an IOFED, Institutional Order Flow Entry Drill. So that's kind of what happened here. But that doesn't mean the fair value gap has been completely eliminated or out of play for the rest of the week, the month. It doesn't matter. You can draw. Let me see here. Let me draw this right here. Oh. And you can stretch this all the way across. And this is still in play. So we still may see the price try to come down into this over the next couple of days, over the next week. Who knows? But the whole point of this is to show you that no, we're not in dire straits. No, this isn't like a huge falling of, you know, the NASDAQ. Yeah, and maybe a little bit of a pullback, you know, but that's expected. Things can't run up forever. What this is to mainly show you is that there are technicals within the boundaries that we have here on the NASDAQ, and to expect price to go, you know, to these specific boundaries. So if we are in the 4-hour, we did see it come down to what I would call a breaker. Actually, it actually came down to an order block. See this big green area with an OB? That is an order block. So order block is basically this red candle that I'm kind of moving my mouse around, if you can see that. I'm pretty sure you can. So that is around the 19,000, let me see here, 983 level, and it can go, basically it wicks all the way down to the 19,900 level. So it breaks down into that. However, it doesn't go outside the body of that candle. It doesn't get down to the wick. It stays within the body, and that's important to note. That usually when it comes down to an order block, it doesn't usually break outside the body. If it does break outside the body and close outside the body, then you're going to see, I would say, generally more of a quicker acceleration to the downside than you would, you know, at the current time. But instead, it kind of bounced off of that, and that's where I also drew this area coming across. This is what I would call a breaker. I think I drew that breaker on the 1-hour chart, if I am not mistaken. So we can jump over to the 1-hour chart. Yep. So there is a And a breaker is defined by a high, a low, and then a higher high. So you have a high kind of right here. It's still a red candle, but it does reach a high point. Then it makes a low, right? And that low is where that first yellow line is. I can probably get rid of this second yellow line, to be honest. We'll be safe with that. But that low kind of reaches that first yellow line. So I can pull up the price on that. Yeah, it's not one to pull up. Okay, so I got 19,917. Let me see if that's what the actual low was, if I'm hovering over that. So the low is... Oh, I got this part in my way, so I can probably move that out. So the low is actually 19,904. So it actually gets down below that area. Oh, actually, I'm at the wrong area. Oh, no, yeah, 19,904. Okay, so it reaches down into that, and that would be what I would consider the breaker. So after it makes this run up on Monday, which there was no catalyst for this on Monday, it just started running up. So, and everybody was like, woohoo, yay, we got a run up on Monday for absolutely no reason. I found that absolutely suspicious, that we would have a run up for no reason. So then it kind of consolidated for the next for the next day, I guess you could say, since Wednesday, even though it does show the Wednesday here on the hourly. Not too much happened on the Wednesday, and then we had Thursday. It opens back up again, and then now I also have an indicator here that indicates what we call kill zone boxes. So the kill zone boxes will tell you exactly what times to look for when price will reach either a high, a low, or some kind of maybe even a turning point, or changing directions. That's generally where you find these things. Now, what are these times? Let me go to the kill zone boxes and let me bring up the settings. Okay, so your inputs here, I usually put it in between. Okay, so I'm in New York time. So in New York time, you usually want it between 1 and 4:30. Right, so that would be roughly the German Open, basically, not London Open, but the German Open, because the German markets are open at that's when they tend to open at that time. And 4:30 is generally when it starts to slow down. The next kill zone you have is from 7 to 10. Generally from 9 to 10 is the biggest kill zone area, but it can start a little earlier. And then, of course, it says kill zone profit area. This is basically the London close. Also, the area the time when there is what we call a silver bullet in the afternoon portion of the market for the New York time frame, and that generally happens in between 1 and 2 p.m. during the New York time zone. I'm in Central, so I'm trying to think about both of those time zones at the same time. So, as you can see, as New York, or not as New York, as London, the London Open or the German Open started at 3 o'clock. I do hope I am in New York time. Let me double check here. Yes, I am in New York time. So at 3 o'clock in the morning, New York time, is when it hits its high. So that would be during the London session, right? And then after that, you can see it starting to slowly fall until we start hitting the New York Open. At the New York Open, what does it do? Well, let's get down from the 1 hour to the 15-minute. Because you can see at the 15-minute, it does make this run down really quick. And I don't know if any of you caught this, because this is what I did. Once I saw it started running down, I put a sell on it, and I saw that this was the liquidity point. So I put that as my take profit. Again, not financial advice for anybody, but just saying this is where you would normally look for price to go. It would look to break a barrier that would have an area to where people would mostly have their buy stops put, because they would think it would buy around this area, thinking that this is a resistance line, right? And then pop back up and start going back up northwards. But this isn't a resistance line at all. This is a liquidity line. So complete difference here. So it breaks that liquidity line. It does pop back up, make people think it's starting to buy, and then drops once again. Now, I caught, again, some of this downward motion because I had a feeling that it was going to break that liquidity line once more. It was going to fake people out thinking it was going to go to the upside. So, to be honest, I ended on a good day. I ended somewhere around in this area, around the 12 o'clock. I made enough to where I said, okay, I'm going to stop here. No more reason for me to keep trading, even though it kept falling, because I called it. Actually, I called the bottom around 19. Let me see here. No, I called the bottom around 20,000. I actually called it at 20,013. Well, once it bounced off that 20,013, I thought, okay, I'm done. I'm not going to trade anymore because I don't know what it's going to do. I don't know if it's going to run up. I don't know if it's going to run down. And sure enough, what did it do? It just kind of consolidated sideways. So, that being said, what is it going to do the rest of the week? I have no idea. Let's go back to the weekly and see. Like I said, it could continue downwards into this weekly fair value gap, or it could leave this fair value gap for another week. Tomorrow is Friday. So tomorrow we could see, I mean, you can see it did leave a huge wick. And it did go 2x from, my 4-hour Fibonacci spread. All the way up, actually more than 2x, almost 2.5x, before it started making its way back down. However, you can still see we're positive on the week, only because of that daily interaction that we had that made this one huge run up right here. And then it fell back down, but then it popped back up. You can see the markets, looks like it just opened again. It is 6 p.m. on the New York Times, so it did just open again. As you can see, there is a bearish fair value gap on this level. So what you could see is you could see it run up into this level somewhere around the 20,137, maybe slowly making its way, slowly making its way up there, and then you might see it touch that, because that could be the median in between this fair value gap. Let me see. It is. See, these Fibonacci's and these fair value gaps, I mean, it's almost like they're science. They're almost laid on top, right on top of each other. So the median of this Fibonacci, or the median of this, fair value gap, is an important Fibonacci level. It's the 1.5x. So you could see it run up, hit that 20,000, let me see here, 137 level, 140, something like that. Right at, probably right around, I'm going way too far ahead. That's Monday, Sunday, here's Friday. So somewhere Friday, somewhere in between, right around in here, because I'm on the 4 hour, so I was going way ahead. I was thinking I was on the 1 hour. So right around in here, maybe around 2 o'clock in the morning, you would see it come up, touch this, and then possibly start making its way back down into, again, trying to break the lower lows, because as you can see, we have 2 equal lows here. That would be where people would think that, again, you would put buy limits, right? So we put buy limits there. People think it's going to buy around this area because they think it's another resistance level, or support level, I should say, and then bounce back up, and then it could, but then it could also drop again, and drop again down into, here we go, this huge fair value gap that we had coming all the way from the 12th of June. So this is where I think it ultimately will make its way back down to. But don't fret after it hits this area or completely fills this area. Um, you know, again, the reason that I feel like it's going to come back down into these areas is because a lot of people see this bar and they think, okay, well, that price was completely filled by that bar. When price doesn't actually do that, price jumps around back and forth, up and down, and it will miss prices, and it actually leaves gaps within these price bars. So price wants to get filled between every level. So if it does leave a gap in that level, it's going to come down and fill it. It's just like a price gap that you would see in between a weekly and you know, one going from one week to another. You know, if it jumps, you know, you always see a wick come back down and close that gap. That's basically what's happening here. There's a gap here that nobody sees because there's actually you know, a full bar that's filling it, and it's not, you know, chopped up in little gaps here. So that's what you're seeing. You're seeing this price come down here and trying to fill up those gaps. All right, so and that could come down as low as 19,000, probably 640, like 630, somewhere around there. It could possibly come down to 19,530. Who knows? It could be one of the two, but it could take a while to get there. We could also see a run up, you know, to make people think that it's going to continue running up, and by the time next week hits, or next month hits, I should say, it could start making its way back down. So you got to be careful about what you're watching and how you're watching it and how you're perceiving it. Again, just keep your eyes open and make sure that you're understanding where your fair value gaps are, where your order blocks are, where your breaker blocks are, things of that nature, because that will all determine which way you know, if it's going to bounce off of one of those and look for the next area of liquidity, because that's what price does. It will look for the next area of liquidity and head toward that area and try to take people, especially retail traders, out. Retail traders that have been taught the most basics of trading, and the institutions know how to go after those people and to take that money and put it in their pockets, and that's what they're doing basically. So that's enough for me for my 20-minute rant, and I hope you guys enjoyed the video, and I will hopefully see you guys soon.